In this video, we will take a deeper look into different fund managers' opinions and outlooks, and how the current stock market environment could be impacted. Welcome back to your Top Tech and Trades channel. And before we proceed, don't forget to hit the like button, subscribe, and click on that little bell at the upper part of your page. "2022 has seen many billionaires fund managers changing their market sentiment in a drastic way. Many have recently become bullish on the market, which is largely opposite to the crowd. To name a few, we have seen Warren Buffett, Charlie Munger, Bill Ackman, Cathie Wood, Chamath Palihapitiya, and Jim Simons investing heavily into growth industries such as e-commerce, technology, and innovation. Certain fund managers, on the other hand, remain cautious. Michael Burry is sticking to his guns, believing that a market meltdown is on the way. Chamath Palihapitiya recently predicted that the S&P 500 index will drop again. Large-cap firms would be harmed, according to Chamath, and the S&P 500 would bottom out around 3,800. The S&P 500 is hovering at 4,200 points, suggesting that one last plunge is not far away. The current market sentiment is that buyers are those of growth stocks and sellers are those of value stocks.
The smart folks that I talk to, who I really look up to and respect, think that the bottom in the S&P is around 3,800, and that what we still need to do is this one last flush, and that last flush will really touch the big cap companies, but that growth is largely done, sort of getting taken to the woodshed. So general, I think that generally buyers of growth now, sellers of value, and waiting for this one last 400 point move down the S&P, and I think people think it's roughly the bottom. Now, if there's a world war, obviously, who knows, all bets are off, but
Billionaire entrepreneur David Sacks echoes this sentiment. Sacks cited research that showed how the value of internet and SaaS enterprises had plummeted. EV revenue multiplies peaked in the 2-year COVID-19 timeframe, then fell to historical norms from November 2021 onwards. Although there is a chance that this may continue to fall, historical data suggests that the bargain hunting time should begin now.
Brad Gerstner's published a couple of charts showing basically multiples in the internet index and among SaaS companies over the last, dozen years or so. And what you can see is that over the last 2 years during COVID, there was a huge spike in multiples for internet companies and for SaaS companies. And that over the last, really since November, the last 3-4 months, has now come down. And as of, I would say, last week, it was right at about the historical trend, and now it's starting to go under the historical trend. So from a bargain hunting standpoint, you'd have to say that this is the first time that we've been below the average for a few years. Now, that's not to say it can't go down even more, because in the same way that you can be above trend, you can also be below trend. And if this war escalates and metastasizes, it will go down more. But if this conflict can stay localized and the economy doesn't go into a recession because of everything that's happened, then yes, this might be bargain hunting.
The CEO of ARK Invest, Cathie Wood, echoes this opinion. Shares in numerous unproductive firms and cryptocurrencies gained a lot of money in ARK's ETF. This was largely attributable to the underlying low interest rate and large stimulus settings. ARK's flagship innovation ETF, on the other hand, has recently been under fire. Cathie's top 40 stock holdings have dropped by an average of 41% in the last 3 months. In comparison, ARK's competitors are only down approximately 14% over the same time period. This larger decrease is attributed to the high-risk, high-growth, high-disruption stocks that ARK Invest favors. Cathie seems unconcerned about the decline. She believes that the losses are just transitory and that the low point was in January of this year. She's also confident that the stocks within the ETF will rebound to prior levels and continue to grow from there. Cathie's sentiment towards the market rebounding is reflected through ARK's investments, which have recently been skewed towards certain high-growth companies. ARK's continued investment in disruptive firms reflects its investment approach, which prioritizes companies with the most potential for change and innovation.
Our companies are investing aggressively now because they see enormous opportunities, whether it's in the genomic space, the robotic space, energy storage, artificial intelligence, blockchain technology. And when you think about artificial intelligence, I think for us, and all we do is focus on innovation. The biggest surprise to us in the last 3 years is the amazing set of breakthroughs in artificial intelligence. We've got AI costs. We've got AI moving more than twice as fast as Moore's law. Costs dropping 60% per year if you account for both the hardware and the software.
To reflect their bullish sentiments, other fund managers have also invested in companies with high growth potential. Jim Simons, head of Renaissance Technologies and one of the best performing hedge funds ever, bet on two of the most well-known meme stocks in the fourth quarter, AMC and GameStop. Bill Ackman invested in Netflix this year. Ackman is usually apprehensive about technology stocks given their higher prices. Charlie Munger recently increased his stake in Alibaba. According to him, the company is a major force in Eastern e-commerce and cloud, and it is projected to develop significantly. The various investments by these billionaire fund managers all have something in common. Their timing plays a key role in understanding the behavior of these fund managers. All of these investments have been made in the first quarter of the year or last quarter of 2021. And it shows that fund managers are finding a lot of profitable opportunities in the current market outlook. The uncertainty surrounding Russia's invasion raises the issue of whether the market will be able to maintain some sort of stability in the face of the pressure. The stock market has seen a lot of volatility and uncertainty as a result of the sanctions imposed by different nations, particularly the United States. Some of the sanctions imposed are limiting trade and financial transactions and freezing assets of Russian state-owned financial institutions. The reason for this is to prevent Russia from accessing most of the substantial foreign exchange reserves and ruining their currency. For the record, these sanctions have only ever applied previously to hostile foreign regimes such as Syria, Iran, and North Korea. However, these sanctions also have an impact on the global economy. It brings more uncertainty towards the market outlook. This is on top of an already shaky market that is still recovering from COVID-19's effects. As a result, risk premiums will rise across the board in numerous asset classes. The sanctions will also be likely highly inflationary because they'll affect the Russian energy sector. Russia is the world's third largest oil producers behind the US and Saudi Arabia, so a substantial portion of the oil supply has been hit. The price of oil, which has risen by almost $20 per barrel in the last month, has already factored in this uncertainty. Higher inflation will occur if the price of energy continues to rise. Given that we're already had significant levels of inflation and supply chain problems, this is a cause for concern. High inflation with slow economic development, known as stagflation, would be the worst conceivable consequence. Stagflation is when an economy experiences high inflation while simultaneously experiencing little to no economic growth. That would be a disastrous situation to be in, because any attempt to slow inflation would only crash the economy even more. Furthermore, these sanctions put further strain on the supply chain, resulting in higher food prices, higher flight expenses, and tighter travel restrictions. There were also concerns over the interest rates, with Fed Chair Jerome Powell stating that they are inclined to support a 25 basis point rate hike. He further explains that they would move more aggressively if inflation does not subside as fast as expected. Federal policymakers claim to be surprised by the persistence of high inflation, as they thought the rise of fast price increases triggered by the pandemic would be temporary. Obviously, this has not been the case. The Fed's primary concern, though, is controlling high inflation. Powell said that the Ukraine situation will be considered when deciding on monetary policy measures, especially as supply disruptions grow larger and longer lasting. There are still many events that are yet to transpire from the Russia-Ukraine war, and there is still a lot of volatility to come. These dynamics, however, are not uncommon, and the pandemic has demonstrated that many businesses can be resilient and even lucrative in difficult times. The actions of the fund managers indicate that the global economy will most likely be able to survive such a blow. There are some outliers in this mix, to be sure. Michael Burry is one of them. Prior to any word on the Ukraine crisis, Burry sold out most of his US equities late last year. This was in preparation for what he calls the mother of all crashes. By doing this, Burry managed to evade the stocks that have tanked following the crash, like Golden Ocean, Marinus Pharmaceuticals, and Scorpio Tankers. Since the third quarter of last year, those three stocks are down 25%, 44%, and 43% respectively. On the other hand, Burry missed out on cashing in on some of his investments that increase in value, like Precision Drilling, Occidental Petroleum, and Ingalls Market. Those three equities have risen by 91%, 38%, and 26% respectively since Q2 of 2021. Burry is just one of several billionaire fund managers who are becoming positive on the market. However, there are potential concerns that are currently impacting the market and will continue to impact the global economies into the foreseeable future. As a result, we must determine if the markets are bullish or bearish. Despite the fact that the market is currently volatile, billionaire fund managers are prepared to withstand the storm. Indeed, many of them feel that now is the moment to look for inexpensive stocks and cherry-pick the ones that will truly be champions. Let us know what you think. Comment down below. If you liked this video, don't forget to subscribe, click the notification bell, and hit the like button. This is your Top Tech and Trades channel. Thank you for watching and see you in the next video.